Of course, this is not financial advice and for entertainment purposes only.
Here is the truth of retiring on a weekly and a monthly dividend ETFs from NAV erosion and reverse splits. So you might be thinking about quitting your full-time job and retiring on a weekly and a monthly dividend ETFs for that sweet passive income and those high juicy dividends. And honestly, I don't blame you because maybe you are thinking about retiring and investing in those high juicy cover call ETFs from yields of about 10%, 15%, maybe even 20%, which is not too shabby for a cover call ETF yield. Because typically those yields experience less NAV erosion, if at all, charts that aren't deep in the red or look like the fund imploded, and solid total returns. However, though, if you want to get paid more dividends, more income, all the income, more paychecks, etc., you can invest in those ultra high yields. Yes, ultra high yields ranging from 70%, 80%, 90%, 100% plus yields. Insane, right? Remember that more yield equals more risk. So higher yields equals higher risk. More volatility, more IV, etc. And always remember that dividends, distributions are not free. Maybe these ultra high yields have, of course, more risk, more volatility, more risk on the options contracts, as well as maybe even more NAV erosion and a reverse split on the way. Who knows? The truth is, can you retire on dividends? Yes, you can retire on dividends, even distributions, even cover call ETFs, but you should always know the risks, the reward, how NAV erosion works, and reverse splits because it's super crucial, especially with these super high yielding cover call ETFs. So in this video, I interviewed Will Rind, the founder and CEO of Granite Shares, to talk everything about yield boosts and even how NAV erosion and reverse splits work from no bias, just pure knowledge of these two topics that are super crucial if you actually want to retire on dividends and even distributions from these cover call ETFs. Alright guys, I want to give you one stock to keep on your radar and watch list, and that's going to be Foremost Clean Energy, listed on the Nasdaq Stock Exchange, ticker symbol FMST. If you love lithium and uranium, then you're also going to love Foremost Clean Energy because investors have been seeing huge interest in the stock because it's been outperforming the stock market, and it's also up over 100% just this year. Yes, I know you might be thinking, Marcos, what the heck is FMST? Great question. FMST is a rapidly growing North American uranium exploration holding an option to earn up to a 70% interest in 10 unexplored properties from Denton mines. The portfolio spans over 330,000 acres within a prospective area of the Athabasca Basin surrounded by high-grade deposits. Foremost is dedicated to realizing the full potential of its projects. I know. Once again, you might be wondering, why FMST? Great question. There are 4 benefits to this company. Number 1 is diversity, which equals increased discovery odds. Foremost holds strategic options on 10 distinct properties across 330 plus thousand acres, maximizing opportunities for high-impact discoveries. Denison Mines is the second benefit. Denison isn't just Foremost's largest shareholder, but provides access to unparalleled technical and operational expertise. The third benefit is fast track to production. Unlike 60-plus competitors, Foremost's partnership provides direct access to Denison's proven ISR technology and operational expertise, key to streamlining development. The Nasdaq-listed stock FMST Foremost Clean Energy presents a great opportunity for investors who are looking to capitalize on the growing demand of uranium and lithium and other great projects and properties under their tool belt. Investing in single stocks especially is high risk, so always do your own research. And let's get started with this video on NAV erosion and then reverse splits, explained by Will Rind. Can you explain what is NAV erosion, and should it be a concern for investors who are investing in these high-yield cover call ETFs?
There's a couple of things on the NAV erosion point, which is interesting and probably should address. So the first point that I think probably gets missed is that automatically, when you make a distribution, you have NAV erosion. Because by definition, the amount that you're paying out has to come from the fund, and therefore the NAV declines. Now, that's no different if you buy any stock in the market, anything whereby they're making a distribution or they're making a dividend payment. So first and foremost, that happens with every security in the market. I think when people talk about this, largely what they're referring to is just the price decline in the underlying. So absent of distributions. And again, this happens if the underlying asset goes down in value, which happens in every other instrument or every other fund in the market. If the market is going down, guess what? Your fund is going to go down too if you have, indexed exposure to that. Those are the kind of the two basic principles. Clearly, we all want to live in a world where the underlying asset doesn't go down and the underlying asset stays either stable or appreciates. But that's just not markets. Markets go down, markets go up. In order to mitigate some of that risk, and again, we can't give people 150% yields and no downside. I mean, clearly, we would love to, but if we were able to do that, I'd be on my own private island somewhere, retired long time ago for sort of cracking the code on Wall Street. There has to be some risk. There's the basic principle of risk and reward.
What is a reverse split, and is it bad for investors investing in these cover call ETF products who might want to retire on dividends one day?
Yeah, so let's start with the basics. So what is it? So first and foremost, this is economically neutral always to the investor. Whether you're splitting in reverse or you're splitting forward, all you're doing is, let's call it artificially adjusting the share price to a different level. And the investor therefore receives either more shares or less shares, depending on whether it's a reverse split or a forward split. But the value of what they own remains the same. So it's economically neutral. The reason this happens can be a number of different reasons. We do it a lot in the levered single stock space because for every leveraged long product, there's a leveraged short product. And there are rules, for example, on the New York Stock Exchange and on NASDAQ where you can't have a share price that's lower than a certain level. So let's say $1, for example. And then you get into the whole penny stock thing. That's a really important point because the way that the market making system works, that the smaller or the lower the share price gets, by definition, the higher or the wider the spread becomes as a function of a percentage over a declining a dollar amount. And then also the more difficult it becomes for market makers to quote because quotation systems only go certain parameters. All of that being said, the main reason is because the share price gets low enough or is in danger of breaching a specific threshold. And so reverse splitting means that you're bringing that shareholding or that share price back to, whatever kind of neutral level, $25, something like that. So it can be a function of the NAV, falling and the NAV falling because the price has fallen, which again, nobody sort of in an ideal world wants to see, but you invest in things, not everything goes up, things go down, and therefore that needs to be adjusted. Or, given these are very high yielding products, let's say the market was flat, then by definition, every time you make a distribution, the NAV falls. So you make a distribution, and the NAV is gradually eroding over time, and the underlying might not even have moved. These are the reasons we're actually going to do the opposite end, which is a forward split on one of our levered ETFs. And that's the reason because the share price has gotten too high. And so go back to, the days of Amazon and some of these other stocks that people are like, whoa, wow, $3,000 a share. Like I can't afford to buy one share. Again, it's all artificial, but it's just people's perception of, what makes a stock attractive. Is it easier for people to access it if it's $20 versus $3,000? Yeah, it like all these things. There's nuance to it, of course, but on the one hand, it's just a normal sort of thing to do. But if it's because the underlying has fallen, that's regretful that the underlying has fallen. It can't fall below those sort of trigger levels. Otherwise, it causes a problem on the exchange and for market makers.
Investors, we have a very special guest
Mr. Will Rind, the CEO of Granite Shares, and you guys might know him as the portfolio manager and CEO as well of Yield Boost. So I'm going to ask you, Will, how do you feel about Yield Boost right now, XBTY, TSYY, all of the Yield Boost suite?
Well, great to see you, Marcos. Obviously great to be here in California. Yield Boost is going great. Very happy. The word is definitely getting out to people. I think the assets are now around about 450 million. So growing that from very low base, even just a few months ago, seemed to be getting inflows on a very regular basis. So super happy with how it's all progressing.
Now, tell me specifically about the investment objective of ETFs like XBTY, TSYY, and the whole Yield Boost suite, because I think it's super unique compared to so many other covered call products in the space right now.
Yeah, so you said it there. The first one is they're not covered calls. And, what we do is a bull put spread, which simply means that on the one hand, we're selling put options to generate yield. Now, on the other hand, we're buying put options to help protect against the downside and some of that NAV erosion that you get with other products. So what Yield Boost does is execute both puts on the sell side and then on the buy side. And we do that on underlying leveraged ETFs. The reason for doing that is because if it's a 2 times leveraged ETF and you sell a put option on that, you're generating 2 times the notional premium of an unleveraged equivalent underlying. So let's say you do Tesla, you sell a call option, for example, on Tesla stock, you're getting somewhere in the region of 70 in terms of applied volatility. You do that on a 2 times Tesla ETF, you're getting around 140. So 2 times the yield, basically. And that's the secret sauce behind Yield Boost.
Now, what type of investor is Yield Boost products for?
So anybody that's looking for high income or high yield, weekly payouts, long-term buy and hold type investors. And it's important to mention in that although we're selling options and buying options on underlying leveraged ETFs, Yield Boost ETFs themselves are not leveraged. It's just simply the fact that the underlying is. So we're selling puts, buying puts, and paying that out weekly. So very much, for a weekly payout program, somebody who's looking for income, high yield in the portfolio, and these are amongst the highest yielding affiliate in the market.
So many investors on my comment section and even on Blossom, Reddit, and X love Yield Boost. Now, what are some reasons as to why maybe investors and even retail love Yield Boost compared to your guys' competitors?
I think the biggest thing, first and foremost, and hence the reason why we call it Yield Boost, is because it's your yields boosted. It's the biggest, typically, yields in the market. And when I say that, the reason is because when you're selling an option on an underlying leveraged ETF, whether it's a 2 times or a 3 times ETF, you're getting 2 or 3 times the income. And that's super important to understand. And that's why if you look at some of the dividend tables or yield tables, you'll see Yield Boost consistently at the top. The way that we try and protect against that downside is by also buying puts on the underlying to give it some downside protection and help against the NAV erosion, which plagues a lot of other issuers.
Now, why not just do like cover calls on a Bitcoin or a Tesla or a Nvidia? I know you guys have the Yield Boost suite for those products, but you guys sell puts and buy puts versus other issuers do the cover call strategy.
Yeah, I think, look, we have the benefit sometimes when you go second of seeing what other people do and saying, you know what, I can improve on that design. And that's sometimes a benefit you get. You may not get the same amount of market share, at least initially, but you improve upon the design. And the weakness clearly of covered calls is that you get all of the downside and you get no upside other than the premium collected. So we're like, how can we do this better? Well, we think we can improve on the design by offering some downside protection, giving people bigger yields and access to a broader portfolio.
How should investors think about Yield Boost in their portfolio by allocating an ETF that is Yield Boost affiliated with their portfolio for like income or just to have as maybe a weekly payer?
Yeah, I think people are already in the space. So I think that what attracts people to options-based income or income dividend type strategies in the first place is people have a need for income. Now, then the decision you have to make is, how much income or how much yield do you want and how frequently do you want it? And if you're looking for weekly payouts, that takes you into the category of Yield Boost. And then I think as somebody who's looking for those like very high yields, that maybe you can generate, 100, 150% plus per annum. Those are the kind of, yields that people are looking for.
Was there any changes made to Yield Boost during April or since April? Because I know so many issuers made changes to their prospectus ever since that event where the market went up like 9%, 10% in one day. And all these new issuers came out with protective puts and changing their prospectus since then to improve their income funds.
It's interesting. No, there were no changes, but I think it's funny you should mention that because we definitely noticed in the last few months a significant pickup in assets and interest. I suppose on the one hand, we've been sort of thinking it was down to, people need to see the payouts for Yield Boost, a bit of a track record, but it might have been that outperformance that people saw versus some other products that help people kind of maybe make that decision in terms of choosing Yield Boost.
Which is the most AUM of all the Yield Boost products in your guys' lineup?
The biggest one is TSYY. That's the Tesla one. And the reason why is because that's also our oldest. So we actually get very good interest in all of the products. But TSYY, just because that was launched in December last year, has a bit longer track record. I think that one has attracted the most in terms of AUM.
Now, what are your thoughts on NVYY as well as XBTY? So many people love XBTY because Bitcoin and MicroStrategy and all those types of products are the way to get income with the high IV and the high distributions from those type of products.
They've done really well. I mean, we launched COYY, which was the yield boost on underlying Coinbase, which has an even higher yield, would you believe, than XBTY. So XBTY, obviously based on online Bitcoin, but this is on Coinbase stock, which is even more volatile, would you believe? And therefore, the payouts on the yield is even higher. So again, very, very excited to see the interest in there of these products. But, like I said, it's interesting to us because there's been interest across the board, less so for YSPY and TQQY, which are the ones on the diversified underlying indices, the S&P and the NASDAQ. Less interest there, but on the individual asset underlyings, there's been good interest across the board.
What's some common misconceptions investors have about Yield Boost?
The biggest one, I think, is that Yield Boost ETFs are leveraged. And that, I think, comes from the fact that we're selling options and buying options on leveraged ETFs. But I think that's really the biggest misconception I see out there. And then sometimes that's reflected even in terms of data providers and things. So there can be some misinformation. But apart from that, I think the concept's fairly, hopefully fairly, clear for people to understand. And that is that it's not just about high yields, it's also about some downside protection as well.
What's something investors could look forward to for the future of Yield Boost and your guys managing all the Yield Boost suite?
So Yield Boost, what people can look forward to is it's a family, and we're developing more of these funds all the time. Hopefully, we'll be able to launch more this month, indeed, and certainly before the end of the year, we're trying to build out the suite. And like I said, the offering, the interest has been so good that people keep telling us all the time, we want to see this one on Yield Boost, that one on Yield Boost, like bring out more. So that's what we're working on.
Well, I'm going to throw it out there of idea, fund of funds, something that so many investors are telling me about Yield Boost. They're like, we need a fund of funds.
Yes.
So what are your thoughts on a fund of funds for Yield Boost?
Yeah, so we've got to get this very strict diversification rules, which means like the number of ETFs that we can have in a fund for a fund of funds. So we think that we've got to get to around about 10, probably at a minimum, in terms of 10 individual Yield Boost funds before we can start to really make that a reality. We're at 6 today, and we're trying to get more out, obviously, between now and the end of the year. So hopefully it's a reality or something that we can bring to market either later this year or certainly early next year.
What is one common ETF investing mistake that you see so many beginners make and that they should always avoid?
I think probably the biggest mistake that I've seen is people sort of trying to think about maybe they optimize for the one ETF that's going to sort of make them the most money, as opposed to just getting started and investing. And if you've got time on your hand, the more important decision is to invest. In other words, to put your money to work in the market. rather than waste time trying to think of exactly what the right thing, the ETF to buy is. So I think the lesson is always, put your money to work, make sure that that's going. And if you've got time on your side, that will be the ultimate determiner of your returns.
Thank you so much for Mr. Will Rind, the one and only from Granite Shares. Now, if you guys like this video, please give it a like because of this coupon we did. And don't forget to check out our last interview right here on your screen. I love you guys so much. Crush the stock market. Take it easy. Peace.